The broadcast is now starting. All attendees are in listen-only mode.
Okay, I think we'll get started now. Hello, everyone. My name is Jennifer Burnett, and I'm with the Council of State Governments, and welcome to our webinar today. This program is part of CSG's eAcademy series, a bi-monthly webinar series designed to provide information and training on the most critical issues facing state leaders, including the latest trends in state policymaking and cutting-edge state solutions. Today's program is the first in a four-part series designed to give state policymakers a basic and solid understanding of risk management insurance and how insurance policy affects the decisions they may be making. CSG has been excited to partner with the Griffith Foundation on this webinar and a series of other events over the last year on insurance-related issues. To say more about this collaboration, I want to call on Frank Paul Tomasello, the Program Director at the Griffith Foundation. He joins us from suburban Philadelphia, Pennsylvania. Frank?
Thank you, Jennifer. Both the Griffith Foundation and CSG share similar missions, which include a commitment to a nonpartisan, non-advocative, and academic approach to programming. And this commitment's at the core of our collaborative relationship. It's our pleasure here at Griffith to work with CSG. Together, our organizations provide an opportunity for policymakers to gain valuable, unbiased knowledge about insurance, and to do so through the lens of critical and emerging issues.
Thanks, Frank. I'll ask you to introduce our speaker here in just a moment, but before we do that, let me talk briefly about our webinar logistics. First of all, this webinar is being recorded, so if you miss anything, it will be soon available on csg.org/Knowledge Center. Also, as I mentioned before, this is the first in a four-part series on risk management insurance. Every other Tuesday for the next several weeks, we will have another webinar on a related topic. You can check www.csg.org for more information. Finally, we will have questions from the audience. If you'd like to ask a question anytime, just type it into the dialog box there on your screen in the GoToWebinar interface, and we'll make sure our speaker sees it. So now we're going to go back to Frank Tomasello to introduce our speaker and to get things started. Frank?
Thanks, Jennifer. We're pleased to be joined today by Dr. Kevin Shaver, a lecturer in economics at the University of Pittsburgh. Dr. Shaver earned his PhD at Washington University in St. Louis. His research is focused on the nature of competition and innovation in insurance markets, and his past experience includes serving as an assistant professor at Duquesne University in Pittsburgh and as an instructor in economics at Washington University and Webster University, both in St. Louis, and at the University of Kansas in Lawrence. In the hour ahead, Dr. Shaver will lay the groundwork for the series by exploring risk management and insurance basics. Subsequent webinars will delve deeper, examining risk management and insurance fundamentals through the lens of a variety of emerging issues. So without any further delay, Dr. Shaver, we thank you for joining us. The floor is yours.
Great. Well, thank you, Jennifer and Frank, for having me here. And I want to thank the Griffith Foundation and CSG for the opportunity to talk today about the basics of insurance. And let me start by just noting that as an economist, I oftentimes discuss topics like this, how markets work. And I want to be careful that everyone understands when I use words such as should, I'm not meaning that in a policy-oriented way, trying to advocate for a particular position. I want to make it clear that that should be interpreted as, for markets to work efficiently, the sort of more scientific approach that economists take when analyzing markets. So with that in mind, let's start with by thinking about insurance basics here. And so what really is insurance? I want to think about it for this talk as an innovation, and oftentimes I think we live in a world where insurance is sort of just a thing that has been here the whole time. It's just something you take for granted. But I want to think instead of it as an innovation, and really a critical innovation. If you look at the development of economies over time, innovation in insurance has been critical to their performance. So you might think of think of insurance like the internet, right? That instead of, it's an innovation that radically alters the way we live, but instead of transmitting information on fiber optic cables, instead insurance transmits financial risk, right, through contracts that allows us many opportunities that would otherwise be unavailable. So next slide, please. So one way to think about this, since insurance is something that we take for granted, is to imagine that the U.S. economy without markets for insurance. Imagine that insurance markets just disappeared today. What would the U.S. economy look like tomorrow? And how would that disrupt the way we live our lives? I think an easy way to think about just how important insurance is to our lives is to start thinking about the different lines of insurance out there and what our lives would be like without them. So no health care insurance, right? So now you can't rely on financial assistance from your insurance company to pay for an unexpected medical condition, right? So this changes the way we would have to live in a number of ways, of course. One, maybe people have to cut back on how much they spend in order to save money on the off chance that they have a health care emergency. It would also then make raising a family much more expensive, much more risky on some levels. Homeowners insurance, it might be harder to own a home. It's certainly riskier in the sense that if there's a fire or there's damage to your house, you aren't prepared to, or you have to do a lot of work to be prepared to handle that. And so we can go on. Auto insurance, a similar story. Life insurance, think about how critical that can be in terms of family planning, in terms of thinking about planning for retirement, and then think about from a business perspective. Businesses depend on having liability insurance, workers' compensation, in order to reduce costs and deal with risks that are part of doing business. And exposure to those risks can make doing business more difficult or even impossible. And thus, there would be many businesses without access to those types of insurance that would find themselves unable to go forward. So the big takeaway from this then is that for the U.S. economy to function effectively, we need to have strong insurance markets. And the better the markets work in America, the better or the less resistance there is to economic growth. All right, next slide. Okay, so then I also want to place this in a context of the rapid use and development of uses, I should say, of information. And this is something that's transforming the insurance world. And so I think we should think about, as I'm talking through the basics of insurance over the course of the next 40 minutes or so, I think we should think about how these new changes might be related to the basics of insurance. So so information in general, and then the use of data in insurance is making significant changes in the way insurance companies deal with various aspects of their operations, the way they set prices, the way they collect data on what their insureds are doing in order to set prices or, well, for a variety of things. So I have a couple of different things that we could think about here that might be aspects of markets that we should consider when we're thinking about this change in information and data. So number one, does this data alter the way we deal with insurance fraud in such a way that it's reduced, it becomes more difficult? This is an important expense of insurance, and thus improvements along that line would help insurance markets function better. Improved pricing. Certainly if we have better information, we can set prices in a more precise way, but that also raises other questions, and we'll think about that a little bit later. Having data on consumers raises many privacy concerns as well. Who owns that data? How can it be used? Much of that is quite personal data, depending if we're thinking about health insurance or some other types of insurance, and so this raises concerns as well. There's also potentially increased innovation that's going on because of this access to data. It creates sort of a fertile ground for new developments to come forth, and so we want to think about that potentially, and then regulatory challenges. How do regulatory authorities keep up with all the changes that data is creating in these markets to make sure that the markets continue to improve or take advantage of all the opportunities to improve better going forward? Next question, or next slide, please. Thank you. So what is insurance? Right, well, so if we want to think about this on its most basic level, we can think about insurance as just a way of transferring financial risk from one person to another entity, maybe an insurance company. And this, of course, we should keep in mind is not transferring the actual risk itself. So imagine that we're thinking about a health insurance contract. You have, you can't transfer the illness someone who's insured might have away from them, but you are transferring the cost associating with treating that illness away from them so that the financial consequences aren't as severe. Right? So that's what insurance is largely focusing on. So we want to think about this oftentimes in terms of protecting these financial interests when losses occur, rather than the deeper issue of preventing the risks themselves. Okay, next slide, please. So let's think then a little bit about the benefits, and also the benefits to insureds, and also the benefits to businesses and society broadly of insurance. So some of these are going to seem pretty straightforward. They're probably the first thing you would think about for benefits for insurance. So it pays to cover an insured's losses, at least to some degree. And we oftentimes say that means, we say that as indemnifying the insureds from this loss. It reduces uncertainty, so planning becomes easier for individuals. It also encourages a more efficient use of resources. If we're going back to that idea of thinking about how insurance markets matter for the economy, if we can protect ourselves from risk, it allows different types of business ventures or opportunities to be taken advantage of in life that might otherwise not have been open to us. And then it also helps to reduce and prevent losses. So there actually can be a level on which insurance changes incentives so that maybe risks actually do fall. Maybe not on the healthcare side. We might even think of an example there too. So, but we want to keep that distinct, that those are two different things. And then we can think about the benefits for a business and society. Certainly it supports access to credit, availability of credit. Think, a simple example of that, and I won't go through all these in great detail, but if you think about an individual trying to get a home loan, banks, in order to protect themselves in case of a person not paying their loan and paying their loan off fully under circumstances, say when a house burns down, in order for the loan to go through, the bank would require that there's a homeowner's policy that protects the collateral or the bank's interest in that loan. And so if we didn't have insurance to protect the bank's interest, it'd be much harder to get loans to buy houses. Right? So credit would not flow as freely, and that certainly has a significant impact on the performance of our markets. Satisfies various legal requirements. So certainly there are situations where risk needs to be managed or contained for legal reasons. Also business requirements. You oftentimes have enterprises that aren't, for various reasons, allowed to take on too much risk, and thus are required to protect themselves. There are a variety of other reasons as well we could think of here. Provides sources for investment funds, and it also reduces social burdens. Right? So you might think about things like long-term care health insurance provides an opportunity for people who are retired to have protection from various types of medical issues late in life, and that eases some of the costs to society of helping to handle those issues. So, for example, at least. Okay, can we move on to the next slide? Great. So, of course, when we think benefits, we also have to think costs, because benefits are only a part of the story. So, for insurance, the natural thing would be to think of the premiums they have to pay. That's certainly a cost. There are also other costs that maybe aren't big, but actually understanding what they are, what they're going to be buying. It turns out these products are relatively complex, and that can be difficult. Insurance providers, well, they face also a variety of costs. Certainly their operating costs, and profit should be included in that as well, as a result of the the enterprise they engage in and the risks they're taking on. We can think about the costs of fraud and inflated claims, and those fall into, we talk about those typically using the term moral hazards. I'll say much more about that later. Claims also can be caused by carelessness or indifference. We call that morale hazards, those morale hazards. And one thing to keep in mind here is that when we're thinking about insurance, it's altering incentives. When you protect people from risk, they may behave differently. Right? And so morale hazard and moral hazard both are hitting on that issue. And then also there's another cost, certainly among many other things, but another one which comes from frivolous lawsuits. And oftentimes there are frictions in the legal system where insurance companies might just find it less expensive to just settle than to actually pursue something. Okay, thank you. Another slide. Great. So now let's think about sort of the fundamental insurance principles. So go back and think about this as an innovation. What is it? For most of history, the ability to share risk wasn't an option. So what are the things that we had to think of that would allow this to work effectively? So 3 basic principles. We'll talk about each of these in turn in more detail. Indemnification, the law of large numbers, and an insurable interest. Next slide. Great. So the principle of indemnity. So to indemnify means to compensate for a loss. Just the way people in the insurance industry talk about compensation for losses. And so one key piece of this principle then is that insurance shouldn't benefit people beyond the value of the loss they face. Right? So I shouldn't be able to take out an insurance policy on my house that's for $500,000 and my house is only worth $250,000. Right? So if people can profit off of insurance, this creates potential problems, which brings us to the last bullet point, which is that with that potential to profit, if we don't cap the amount that can be paid out by a policy, the frequency with which losses might occur for insurance companies would increase, and the severity, meaning the amount that would have to be paid off for those incidents, would also increase. We've created an opportunity for fraud, for sure. All right, next slide, please. So now we get to the law of large numbers, and this is a mathematical principle, and it's critical to the actual effective functioning of insurance markets. So what's the idea here? Well, if we think about individuals, and maybe we think about this in terms of auto insurance, you have an insurance company that's insuring a lot of drivers. Well, for each driver, they have a risk of getting into an accident, and that risk is unpredictable, but when it occurs, for the driver, it could be a very large financial cost, right, and beyond, right? So drivers potentially are going to benefit from being able to protect themselves from the financial side of that risk. An insurance company then, if you think about things from the insurance company's perspective, if they're insuring a lot of individual drivers, they then are able to bring together all those losses, right, and then balance those out with all the premiums that people have paid who didn't have losses. And the law of large numbers tells us that when we aggregate all those individual risks, right, all those individual drivers' risk of accidents, assuming that their chance of having accidents is independent of others having accidents, that out of that pool of drivers, we can expect a pretty predictable amount of accidents. In fact, we can predict with a lot more certainty the amount of money that we'll have to pay in claims. We won't be able to say from the insurance company's perspective who's going to have an accident, but we can say that out of, say, 100 drivers, we should expect to see 10 drivers have an accident over a year. And that's pretty easily predicted. And thus, at the insurance company level, at the aggregator level, we can take that risk and actually make it predictable and manageable. All right, next slide, please. All right, and then finally, there has to be an insurable interest. So an insured must suffer financially for some reason due to that loss. All right, so you can think about a driver whose car might be totaled from an accident. Or you might have a company, it doesn't have to be one's own property that's being insured. You could have a company that takes out a life insurance policy on its CEO in case of an untimely death, right? Then you have an issue where the company would suffer from that, separate, of course, from the CEO, him or herself. And so there's an insurable interest there. And then also, this supports this principle of indemnity again, right? That one can't gain from some other loss that's not insurable. All right, please, next slide. Okay, so we want to move then on to economic issues with respect to pricing of insurance. And so insurance policy pricing is actually a pretty complicated and really interesting process. And that accounts to some degree for some of the complexity in the industry and some of the need for regulation. If you could move on to the next slide. Great. So let's break this down into four key issues of insurance pricing. So I say here that, in the slide, that insurance markets differ from traditional markets in many ways. These four issues aren't an exhaustive list, but they're critical elements that an economist, as we look at these markets, would identify as separating insurance markets in a way that makes them, if not unique, quite different. So the first is adverse selection. Then we talk about moral and morale hazard, equity, both actuarial and social, and then timing. And we'll talk about each of those in turn as well. Next slide, please.
Dr. Shaver, Frank Tomasello at the Griffith Foundation with a question or two, if we could pause for a moment. Are you able to chat a little bit more and speak to how insurance markets differ from what you've referred to as traditional markets? Specifically, how do these differences necessitate differences in policy and regulation between the types of markets?
Yep, absolutely. I'd be happy to. And actually, some of this will be developed here on the next slide or two indirectly. But let me set that up before I get to those. So if you think about insurance markets, it turns out that the product that's being sold is very different from many other products in what I would refer to as traditional markets. So a simple example would be thinking of, let's think about McDonald's, for instance, and selling hamburgers. For McDonald's to sell a hamburger at a particular location, the cost of producing and selling that hamburger is a known quantity to the company. And the cost doesn't depend on who they sell the hamburger to. And so they have a lot of information about the expenses they're going to have on the front end, and that lets them make better business decisions in terms of pricing and strategic decisions within the market. But if you think about an insurer, that's absolutely not the case. Who an insurer writes business to, who they sell policies to, it is critical in determining the actual cost of their business. So, if I go buy insurance from a company, I might pose a particular risk and thus a certain cost to the company, and someone else might pose a different one. And not only that, the company, when they sell the policy, won't necessarily know what the cost is going to be of insuring me, because they're protecting me from the potential for something to happen in the future. So both of those things create this lack of information, and then the costs are dependent on who you sell to are two components that are oftentimes not present in markets as we conceive of them more broadly. And so they actually can, those plus other aspects of insurance markets contribute to a situation where competition doesn't ensure outcomes that are efficient like we would expect to occur in normal markets. That makes sense? Any follow-up questions, Frank?
Thank you, Dr. Shaver. It does indeed make sense, and I appreciate you clarifying. Another question to sort of loft out there, and my sense is that in the slides ahead you may address this topic, but if you could, and if this is something you'll speak to later, not to worry, but are you able to chat a bit more about the impact of fraud on insurance pricing as well? And I would imagine that sort of falls under that moral and morale hazard.
Yeah, right. Right. No, absolutely. So yeah, why don't we hold off until that's maybe a slide, just a slide away, and then I'll take a little more time to think through that as we go through that. Fantastic.
Excellent. That would be wonderful. But before we pick things back up, I'll take a moment as well to remind the folks who are joining us that they're able to submit questions for you by entering them into the GoToMeeting interface that Jennifer Burnett had referenced at the beginning of the program. So we invite folks to feel free to do that, and as questions come in, we will take a look at them and pose them throughout the session. So thank you very much, Doctor. Appreciate it.
Great. All right, so let's think then about these four features of insurance markets that make them different here. The first being adverse selection. So this gets back to the issue I was in response to the question about what makes insurance markets different. This is one of those components that there's in insurance. We talk about this as a selection problem, but who you sell to matters, right? So in many markets, the dynamics of picking who you sell products to or being careful to sell to particular people do not matter in the same way as they do in insurance markets. Oftentimes what you'll find is those who are most likely to buy insurance are the ones that are most likely to have losses, and maybe even bigger losses. So individuals who are buying insurance know that they're at risk. And so if insurance companies end up selecting poorly, and when I say select, I don't mean they're picking who to write to necessarily, but just that they end up selling business to a group of people that tend to be more at risk of having losses. That they can find themselves in a situation where their costs are much higher than they had anticipated. And so that creates potentially big problems for insurance companies. And there are certainly some dynamics in the competition between firms using information, as I was, as we talked about at the front end, that's becoming available that might exacerbate these types of problems. Okay, could you go to the next slide? Great. So certainly, since adverse selection is potentially a problem, the need to avoid it is important. So one way insurers do this is by collecting as much information as they can on their insureds, and then using that information to more effectively anticipate the expense of insuring them. And so as data becomes more available, insurance companies are able to more precisely predict the expense associated with a particular insurance contract, and thus price it better. Data collection, though, of course, raises privacy concerns, as I mentioned earlier. Issues of what information is relevant, what is appropriate, or what can insurance companies collect, how much information is too much, and on both of those, you could imagine that a market might function better with less information being collected. So almost like an arms race, there could be costs associated with collecting information, but that information is only valuable if someone has more of it than their competitors. And once everybody develops that information, there's no real gain. So information it's a particularly tricky issue in insurance markets. Then there's the second, or this third issue of how insured information should be stored, and then can it be shared? Is it portable? Also is an important issue for consumers in terms of trying to find out to shop across different insurance companies. Next slide, please. Great. So this we can get back to the fraud question here. So moral and morale hazards. So what are we dealing with here? So economists actually just talk about moral hazard. I think this is a useful distinction, though. So behaviors, generally we mean this, that there are certain behaviors that occur when someone's insured that increase the loss frequency and or the severity of losses. So when we think about moral hazard, we're thinking about dishonesty, that somebody, once they've purchased insurance, knowing that they're protected from certain risks, actively acts differently, intends to act differently, and use that insurance as a way to protect themselves from those risks. Right? So they're fundamentally the behavior changes, but that's an intentional act. In fact, maybe that is a part of why they got insurance in the first place. Morale hazard then is more about carelessness or indifference. It's that when people are insured, even with the right intention, with the intention of just protecting themselves from risk, they might find that they become more careless unintentionally, or they might be indifferent between riskier situations. You can imagine someone who's driving a new car that has a collision policy that will cover any damage to their car when they are at fault for an accident, and think they might drive a little differently from somebody who doesn't have that coverage and thus would have to pay for the damage to their car if they're at fault out of pocket. And that's not necessarily, so it might just be that, that indifference or that lack of attention, but not something that's intended generally. So this is a common concern in auto products, thinking about liability products, general liability insurance. One method for discouraging this is creating risk sharing. And so if we think about fraud, it might even fall into this moral hazard category, in some circumstances. And increase in information actually can allow us to address fraud maybe more effectively. And oftentimes the way we structure our products in insurance markets can also reduce the amount of fraud. So, for instance, if you think about this last bullet point, deductibles, oftentimes addressing moral hazard is something that's done through not taking away all of the risk that the insured is trying to insure themselves from. So, you can think about this with trying to reduce the use of, trying to prevent excessive use of healthcare services with health insurance by creating a deductible where people pay out of pocket for the first several $1,000s of services they receive. Enough money that it's not worth paying that money to then get access to greater financial protection that comes after you've reached the deductible. And so that also takes away some of the incentive to engage in fraud. Because the return is going to be lower under those circumstances. But then let me go back to the information side of this too. As insurance companies are collecting more information and are getting better at managing the information that they have, it's much easier to develop techniques for identifying unusual patterns in claims that are made that then would raise a flag about potential for fraud. And so insurance companies can become much more focused on cases that are likely to be cases of fraud, or more likely to be. And that helps with this sort of balance that insurance companies face, that while they would like to investigate and prevent fraud, that's expensive. And so if you don't have a good way of identifying which policies are likely to be cases of fraud. And so information might very well allow for insurance companies, increase information, allow them to be more efficient at this, and then lower the expense and actually prevent fraud because it's caught more frequently. Okay, good. Next slide, please. Okay, so another issue then that we're facing is this idea of actuarial equity versus social equity. And so this first bullet point, I start with fair discrimination. So what does that mean? What is the fair way to discriminate? And here we're talking about setting prices for insurance. How do we discriminate between different people in ways that capture the difference in expenses or exposure to risk that they present? Right? So this is critical to insurance pricing. Now, there are state laws that prohibit different types of discrimination, and now those oftentimes bring in more social considerations. And certainly, there are certain types of discriminating between individuals that we think are morally inappropriate, or through political processes decide are not things that we should be doing. And so those also come into play in terms of setting insurance rates. And this last point is, well, what's interesting too, though, and one thing that can be difficult for insurance companies is that different states set different standards. And that can be good because that allows each state market to be tailored more to the particular needs of the populations. On the other hand, it creates administrative difficulties and expenses when companies have to develop different insurance products across each different state to be in line with those the standards, the statutes that determine what is fair or unfair. Okay, next slide, please. Great, so let's think about equity a little bit more carefully. I can go into this a little more deeply. So we have actuarial equity. So this is basically setting premiums in a way that's proportional to the risk that an insured is exposing the company to. And so this is really based on costs. And so how do firms do this? Well, they look at the various variables that they can, or the data they can find on individuals, look at how that's related to the likelihood of losses and then the severity of losses, and then use that to estimate how much they think it's going to cost to insure someone. Now, some of those variables, depending on the state, as I was just mentioning, might be prohibited by state law. And so then companies have to think about other ways of doing that, or not actually price those aspects of individuals' costs, potential costs. Now, the social equity, which was sort of mixed in with what we were talking about earlier too, is more about thinking about how pricing should be done in a moral or from a policy side. So we think about there things like the ability to pay. Should all people have access to insurance of certain kinds? And also we think about this in other ways. We might think about it, in some levels it depends on how we think about insurance. Some factors pose financial risk to people but are outside of their control, and do we think insurance products should protect them potentially from that? So you might think about health insurance and somebody who has a genetic predisposition to heart disease. Is it appropriate for that person to pay more because they have this likelihood of being more expensive to insure and having health problems? Or should insurance be able to protect people from having that predisposition, meaning that the price of their insurance policy shouldn't be different, even though the cost of insuring them is potentially different? All right. So those, again, are more moral questions. Those are questions that we think about, but that are decided through a political process. Next slide, please. So then the last thing here is talking about timing, and I alluded to this a little bit earlier about not knowing the expense of a policy when it's sold. There are different types of losses, and insurance companies, depending on the product they sell, may deal with one or both. So short tail losses are losses that are quickly recognized, easily valued in the short term, and then settle. And examples of that might be comprehensive coverage for a private passenger auto claim. Say hail damage. It doesn't take long to take a car to a body shop, get a sense for how much it's going to cost to repair, and then actually cut a check to the insured who's covered. Now, long tail losses pose a very different dilemma for insurance companies. These are losses that oftentimes can take a long time to manifest. They're oftentimes difficult to value, and then they take a great deal of time frequently to settle as well. So you can think about bodily injury claims, so liability, someone in an auto accident, they may have health problems that develop from that accident 2-3 years down the road. Or you might think about asbestos claims if you're wanting to think about a very long-term tail. So and so the longer the tail, the longer the timing, the more difficult it is to set rates appropriately, and so the more complex pricing becomes. And so greater data, as we're talking about, the increase in data that's available can maybe help us address these problems to some degree, make it easier to work for markets to work more effectively on some of these longer tail terms. Okay, could you take the next slide, please? Okay, so real quickly, let's break down some of the characteristics of insurable risks. So, and some of this will start to sound familiar. The first one actually hits on, to some degree, on the law of large numbers, that you want a large quantity of similar people or objects that may be subject to a loss. So you want a pool of comparable people or objects that you can then sell your insurance product to and pool their risks together. Losses should be fortuitous. So if they're predictable, that's a separate issue. So it's got to be chance. We can't predict when it's going to happen, so individuals have to be protecting themselves from that risk. The amount of an expected loss needs to be able to be predicted. Otherwise, insurance companies don't know how to set a fair or appropriate price. Losses can't be catastrophic to the insurer. If the insurer goes out of business, then they can't satisfy all the contracts that they've written, and so that's a situation that we want to avoid, typically in insurance markets. The time, the location, and the extent of a loss needs to be able to be determined. We have to have information on this in order to address the issues in satisfying a contract. And then covering the expected losses, not only so slightly different from catastrophic, it still has to be economically feasible for an insurer. Right? So that catastrophic is much more extreme. Is the insurer going to be in a place where they can actually satisfy on a reasonable level the needs of the insured? Next slide, please. Okay, so then let's think about what an insurance product looks like. And so insurance products are different from a lot of products in a number of ways. Next slide. So one issue is this tangibility. It's always nice to buy something like driving a new car off of a lot. You know what you bought. But with insurance products, there are no real physical characteristics. You get a piece of paper with a lot of information about what's in the contract. It represents a promise, and that's a real thing, but it's only a promise that's realized in the event of a loss. I think oftentimes there's a sentiment among consumers that insurance is, they paid for something and they didn't get anything back for it when they go, for a time period without a loss. Now that's of course a lucky thing, and they were still protected from risk, but it's not an easy thing to see. And so it's easy to miss what all is being purchased with an insurance product. The product benefits only typically become apparent when there's a loss, and depending on the nature of the product, what's being insured, this could be a very unpleasant time for those insureds. You think about a health situation, and it can also be a situation that's emotionally very complicated and very difficult. And so insurance companies are in a difficult situation in terms of assisting their insureds when they're dealing with these losses. Next slide. So another component is the complexity and the legal and sort of the legal status of these contracts. In fact, I think if you take a look at an insurance contract, it's a little bit like a credit card contract. There's a lot of legal terminology that's difficult for consumers to understand. On top of that, with insurance products, it's oftentimes very difficult for consumers to know exactly what the coverages do. So the breadth of coverages. So if we think about auto insurance again, we could imagine, what does comprehensive insurance really cover? When does collision insurance actually, replace the value of my car? Those things, there are oftentimes qualifications on those, and so those things can be very confusing. And so that can be a hurdle to insurance markets working effectively. And oftentimes you will hear about people who have insurance products that are upset about them when they have a loss because they didn't recognize that there were limits to the coverages that were in the contract. Again, a failure to convey information. Also, given that insurance policies are legal contracts, resolving the situations when there's a loss oftentimes can lead to messy legal situations where attorneys are hired, courts may be involved, it may even go to regulators, or legislators may step in to address an issue going forward. So there are a variety of issues here that make this product, insurance products, relatively tricky. Next slide, please. All right, so now we can also think about insurance and how it's used as a way to manage risk. So you might imagine, you can think about this as companies, as businesses, or as individuals. We're all exposed to risk. So how do we handle that risk? Or do we do nothing at all, right? Next slide. So here's a basic sort of approach to risk management. So first off, in the process is identifying what risks one's exposed to. And upon recognizing those risks, of course, one might not be able to predict all of them, and that becomes another difficult category, the risks that you don't know about. But upon identifying what risks you think you're likely exposed to, analyzing those risks to identify how severe those risks are, how likely they are to occur, thinking about the nature of those risks is critical. The next step would be mitigating those risks, and that's can you prevent the risks? Certainly, certain types of risks are avoidable. Other risks are unavoidable, but you might be able to alter various aspects of your situation to reduce the risk of those issues. And then finally, there's this question of, does one retain or does one transfer that risk after you've gone through these earlier steps? Next slide, please.
Dr. Shaver, Frank Tomasello with a question to inject here, going to risk mitigation. Are you able to speak for a moment or two about perhaps some mitigation techniques that are used to prevent or reduce risks? And kind of as a follow-up, are insurers offering incentives to those who employ some of these mitigation techniques?
Yeah, absolutely. That's a great question. So a couple examples. So first off, you might think about, if you think about healthcare insurance, you might think about wellness programs, and these are also, getting to the second part of your second question, these also involve incentives and pricing differences. So you might think about programs that encourage companies employees to get health checks, to engage in physical activity, that there are incentives there that if potentially in some contracts where if enough individuals are participating in this program, the price of insurance will go down for the company and for those individuals. You oftentimes see in health insurance even insured individuals who are covered receiving payoff money for various types of positive of activities that improve their likelihood of not having an illness. So regular checkups that make sure that that make it more likely to catch any illness early and before it becomes more expensive to treat and more damaging to their lives. You can think about auto insurance. You can think about examples of discounts for individuals that participate in safe driving courses. With some of the new technologies that are used to price individuals by tracking their driving, there is a reduction in the price of insurance when people drive more safely and at times of day when they're less likely to get into accidents. And certainly there are older types of, there are more traditional ways of dealing with some of these issues, like you think about homeowners insurance and discounts that are associated with having fire or security alarms, or improvements in the house that make it less likely to suffer some sort of risk, suffer from some sort of risk. So yeah, okay. So getting back into this, does that fully answer the question, Frank? Anything else you'd like me to speak to?
No, that's very helpful. Thank you. Greatly appreciated. Great.
So, so then retaining and transferring loss exposures. I want to go into a little more detail with this. So some loss exposures, when you think about whether to retain or not, some of them aren't going to present a serious issue in terms of cost, and they're worth retaining. Others, though, might rise to a level that one feels that they need to be avoided. And so, businesses do this, individuals do this. They then move to this step of thinking about how to transfer this risk. So for those that can't risk exposures that are managed better through transferring, oftentimes that transfer is to an insurance company that provides that protection. And there are other parties, other ways of diverting risk as well. Probably goes too far afield for now, so why don't we move on to the next slide. All right, so then we can say a little bit more about insurance markets and how they're regulated, why they're regulated. In part, I guess what I would say here is that some of the features of insurance markets we've talked about and the nature of the product itself are justifications that are given for some sort of regulatory influence. The idea is that insurance markets, when left to their own devices, do not ensure an efficient outcome like more traditional markets oftentimes will. And so insurance regulation is oftentimes seen as a way to make sure that those forces that might be imbalanced in insurance markets remain in balance. Now, there's a second issue, of course, with regulating insurance markets, which goes to the policy side, the more normative or moral questions about what's the right thing to do in terms of how companies discriminate with price, for instance. So there are these two sort of components. There's one, making the markets work as efficiently as possible. Then two, there's this issue of the morality of the markets. Next slide, please. Great. Okay. So with that in mind, let's think about a little bit about some of the basic aspects of regulation. So one key element is consumer protection. So regulating and standardizing insurance policies. I mentioned earlier that policies can be very complex and difficult to understand. The more uniform the product is that's being sold across all the companies in the market, the easier it is for consumers to compare the products between the companies and understand what's being sold. Now, of course, that standardization has a cost. It means that companies can't tailor their products to particular needs. And so there has to be a balance between those for the most efficient market, possible market. Controlling market conduct and preventing unfair trade practices. So there's the potential for an imbalance in terms of the power that insurance companies have relative to the consumers. And so regulation oftentimes is focusing on that to some degree. And then ensuring that insurance is available and affordable. So there are arguments for access to insurance, maybe that aren't coming from the efficiency side, but come from the more policy side, from the policy-oriented side. One other big feature of insurance solvency, of insurance regulation is solvency. So insurers, in order for insurers to actually pay claims, they have to still be in business, right? So oftentimes, in fact, one of the big initial justifications for regulation was to protect the public interest because of circumstances where competition was driving insurance companies out of business. And then finally, to safeguard the funds that insurers hold until they need to be distributed to individuals that they've promised to insure. Next slide. Great. So that's the end of what I have to say in terms of the basics. I'd be happy to take some time to answer any more questions that are out there.
Dr. Shaver, thank you very much. We've covered a lot of ground. Questions abound, and time is limited here. We should take a minute and remind folks that if they have questions, they certainly can submit them for you by entering them into the GoToMeeting interface. A couple of questions for you. We'll cover as many as we can here in limited time.
Okay.
Dr. Shaver, I don't believe that we've talked at all about the topic of reinsurance. So this question is before us. What is reinsurance, and what role does it play in insurance markets?
It's a great question. Right. So reinsurance is ultimately, you can think of it as insurance that insurance companies buy to protect themselves from unexpected losses or losses that are too large. So if you think about this idea of transferring risk, you have individuals that are consumers of insurance in a market. They're all exposed to lots of risks, and they're looking to protect themselves from those. They go to an insurance company and buy a policy and transfer that risk to the insurance company. Once insurance companies are holding that risk, the law of large numbers helps them make it more predictable if everything is set up correctly. But there still can be there's still risk associated with holding that risk, with that transferred risk. So oftentimes, insurance companies, in order to protect themselves from that risk that they've taken on, they go ahead and then buy insurance over some of the policies, or potentially all, depending on how it's structured, that they have already written in order to take some of the edge off if an unexpected rash of losses occurs, for instance, and thus they end up having to pay out more in claims than was expected. And so I think that's so generally. So there are insurance. I mean, really, the reinsurance market is an international market. There are a fair number of reinsurance companies. They sell, really, their consumers are insurance companies, and they're just to be honest, so there are a number of different types. Actually, I guess I could say a little bit more on that. You can think about sort of different types of reinsurance. Some reinsurance is what we refer to as proportional reinsurance, where the insurance companies basically insure some percentage of their business. So maybe 25% of the losses that they might experience will be taken by the reinsurance company, and so they avoid some part of the losses they might have through that type of market. Now, there's also what's referred to as another category called non-proportional reinsurance, and there you have a situation where you might have insurance companies that are more just worried about, say, excess loss. That they think they've got a good handle on things, but they can't predict the likelihood of something that's more catastrophic, and so they basically they buy a policy from a reinsurance company, where the reinsurance company only starts to take on the risk after a certain amount of premiums are paid out by the insurance company. So, it might be an insurance company buys a policy from a reinsurance company that covers the first $5 million, where the insurance company will cover the first $5 million of claims it has to pay out. But beyond that level, the policy from the reinsurance company will cover payments going beyond that $5 million. So the insurance company then knows its losses are capped at $5 million. So I think that's any further question on that, or other questions?
A quick follow-up on the topic of reinsurance, then another question or two as time permits here. Are reinsurers' rates approved by state regulators? And if not, can you talk a bit about how they are evaluated with respect to financial health, ability to pay claims, et cetera?
Yeah. Okay. So I can give you a couple of things on that. At least my understanding of reinsurance markets is, in fact, that rates are not regulated. Whereas if we think about auto insurance markets or homeowners insurance, rates are actively regulated. That said, though, there absolutely is regulation of reinsurance markets. My understanding of reinsurance is that the goal is more about solvency. And so you have issues of sort of, I guess the way I've heard it sort of described, and I think I could say it best, is that you sort of have direct regulation where you have states, insurance, the insurance departments that have certain expectations for how much in the way of assets and the type of business reinsurers are writing in order, sort of requirements for surplus or the minimum capital on hand, these types of restrictions to make sure that the reinsurance companies that are writing reinsurance in that state's market are going to be available or solvent, right? Available when they have to meet claims. And this could also be things, this can go over into things like investment restrictions, that they can only invest their funds in certain sort of safe assets, and so forth. Then there's also more sort of what I would say is sort of indirect regulation, where it's not the insurance company directly being in sort of saying, okay, this is how transactions have to occur on reinsurance, but that there can be sort of policies where maybe for accounting reasons, that if reinsurance companies organize themselves in certain ways, they can avoid certain expenses, or they can actually maybe not have to hold as much in reserve, or some that they hold in reserve counts against their liabilities in a way it wouldn't have otherwise. I think that's about all I will say this: that reinsurance is not an area of my expertise. So we're getting to the point where I think I would say if you have further questions on reinsurance, that in some of the subsequent webinars, I think you'll have people that are going to be better positioned to talk in more detail about that, and I would certainly recommend asking. I think it's a fascinating area.
Very helpful. Thank you very much. In the interest of time, just two further questions for you.
Okay.
You talked a bit earlier about this notion that insurance products are at times difficult for consumers to understand, and that it's difficult for consumers sometimes to value what insurance provides them. Do you have any thoughts on how those dynamics might be addressed?
Yeah. So sure. I think generally, so one thing I spoke to earlier, not in a whole lot of detail, but that I think standardization of policies is one aspect. The easier it is, the simpler the policy is, what is being purchased, the easier it can be explained to people, and the more it stays the same from company to company, the less difficult it is to understand what you're buying. You can think of examples where, especially with legal contracts, I think this may be going a little far afield, but I think that, as I recall, in the state of Missouri, when you're looking at leases for renting apartments, that leases, there is basically there's a certain standard for what a lease can hold and what it can't, and that's uniform regardless. All leases, it applies to all leases, and so even if someone wants to write an unusual contract for leasing an apartment, that it doesn't supersede the general lease, and so consumers are protected by that general contract. And so form. And so I think that's one thing, is creating enough uniformity so that it's easier to understand what's being bought, and that it's harder for it reduces that variability. Now, I said, of course, I also noted that there's a downside to that, and so there's some balance there. Another issue that I think is really exciting is thinking about, and this is something that I think is really important for policymakers when they're thinking about these issues of all the new information and data that's being used in insurance markets. By using information, I think we can actually we can address some of these issues. And so let me say it a little bit differently here. So if we have, so say we're thinking about a consumer that's wanting to buy an auto insurance policy, and one innovation that exists now is that there are some companies that will track where you're driving, and there's an app that you can have on your phone that actually gives you feedback on how you're doing, what impact the driving style that you're engaging in will have on your premiums. So you get this flow of information through this innovation that actually makes it easier for a consumer to understand how their behavior relates to the price of the product they've purchased. And so when we're thinking about, when policymakers are thinking about navigating these issues about regulation of information and its usage, I think it's important to think about leaving space within those standards that are developed for innovation, so that companies can come up with products that actually might help solve this problem of streamlining the consumer side of the market, so individuals know what they're purchasing. And those incentives matter. That can change. Those can change the way people. Those incentives can change the way people behave, reduce the amount of accidents, for instance, if we're thinking in auto insurance, and thus create actually a much more efficient market. So information is a really interesting component of this problem of trying to improve, how well consumers understand what they're purchasing. There are also other traditional ways. Departments of insurance oftentimes have a wealth of information online. Having consumers access that and understand that effectively is another issue as well. That's also tricky. So there are a lot of more traditional sort of ways of trying to help improve the flow of information in markets like these as well.
Very helpful. Thank you, Doctor. We have exceeded our time allotted for the afternoon here, but let me sneak in one final question. If this is something you can briefly address, that'd be quite helpful. In instances where existing risks may not meet requirements for the private insurance market, the government can sometimes become involved in insurance markets. Can you talk just a little bit about that, perhaps through the lens of the National Flood Insurance Program or other programs that folks might be familiar with? And I note that if this is territory that will be covered in some future programs, that'd be helpful for our listeners to know about as well.
Okay, sure. So I guess I would say then, I'd say really quickly about that, let's take the National Flood Insurance Program as our example. If we go back to that list of characteristics that make a risk insurable, there are a couple things that immediately stand out that pose a problem with flooding and insuring people from flood damage. So one thing was noted on that list was that it needs to be economically feasible for an insurer to cover the loss, whatever it is. And then even going further than that, we can think about it can't be catastrophic. So maybe if we think about it, it might be large and occurring at the same time. So it's not just an expensive loss or a couple of expensive losses, but a large number of losses that are expensive that all seem to happen at about the same time. If you'll remember my example earlier about the law of large numbers and its importance for insurance, the idea is that when an insurer takes on risk, it's predictable for them and manageable because all the people who bought the policies that are transferring their risk to the insurance company are in fact independent of each other, and so they're not likely to all have accidents or losses at the same time. Well, when you think about flood insurance, that absolutely isn't the case. You oftentimes think about a hurricane. In Florida, you have a situation where you can have a large number of policyholders with large, with large expensive losses all occurring at exactly the same time. And so this is the type of risk that insurance companies, it almost magnifies the risk in a sense. The insurance company is going to have a very difficult time collecting and having assets on hand to account for that major shock that comes from a weather event like that. And so that's in fact part of the reason for the government stepping in. Ultimately, the U.S. government in this case, governments have the ability to absorb the risk on a level that a private institution like a firm just can't do. So usually with a lot of these, same thing with unemployment insurance, you have a situation where you have this breakdown of independence. It leads to quite large losses, and it's a risk that isn't easily managed by insurance companies. And so there's this additional sort of backstop. That said, you could argue that these markets could evolve and through reinsurance or other types of new institutions that it would be more manageable. And so that's always something to keep an eye on. But traditionally, it's the approach has been to use the government to back up certain types of insurance that are subject to these issues.
Dr. Shaver, thank you very much. It has been an informative hour or so. We appreciate your insights and thank you for joining us. Also thank all of the folks who've attended and submitted questions to us as well. I want to turn things over to my colleague Jennifer Burnett at CSG to share some final thoughts. Jennifer?
Thanks, Frank, and thank you, Dr. Shaver. As I mentioned at the start of the webinar, we will be we recorded this and we'll be archiving it in the CSG Knowledge Center and by the Griffith Foundation. So if you missed any part of the program or would like to recommend it to a friend, it will be available within the next week online. And also I mentioned that this is a series, so our next webinar in this series will be on September 27th at 2 p.m. where we're going to hear from Professor David Puser from St. John's University on property and casualty insurance basics. So on behalf of Frank Tomasello of the Griffith Foundation and the Council of State Governments, thanks everyone for joining us today and have a good afternoon. We're done.